Welcome to another installment of InsMax Insurance Brokerage's Thursday webinar series. I'm Larry Carrasco with InsMax, and today I'll be discussing life insurance, the timely tax tool. And at the end of this presentation, I think you'll see that life insurance can be integrated into your client's overall planning to solve a variety of tax issues that they may be facing. InsMax Insurance Brokerage is an independent marketing organization and brokerage agency for more than 30 carriers. We've been doing this for more than 20 years, and our job is to help you get your life, annuity, long-term care, and disability cases seamlessly processed and provide the protection that you're looking to integrate into your client's plan. We want to make you look good. We're an agency you can trust. We've been doing it with thousands of brokers over the last 20 years, and we certainly look forward to helping you. So our agenda today is taxes and how the big picture State of the Union and the states for that matter factor into those taxes and what might be the best vehicle for tax mitigation. That includes deductible programs, deferred programs, and those that can pass money free of taxation to your beneficiaries. We'll do a little bit deeper analysis on a couple of sales ideas and then take any questions. So taxes are here. We experience them daily from income, estate for certain people, sales taxes, capital gains taxes. In fact, when it comes to estate taxes, I bet some of you weren't aware that there are certain states in the United States that actually have their own version of a death tax. In fact, we have got some tools, especially from our wonderful carrier partners like John Hancock in this case, where we can send information to you about different states and the properties of life insurance in terms of creditor protection potentially, as well as estate tax inclusion in those states. And we have an interactive tool that we can share with you that can go state to state to talk about each one of those levels. Just give us a call and we're happy to share. But let's get back to the presentation, shall we? This is a scary page that I discovered called the usdebtclock.org. As of today, April 8th, 2021 at 9 a.m., the national debt was $28 trillion and growing. While it's a busy slide here, it's important to point out that for me, that's one of the most important things that the average citizen doesn't understand. I'll blow it up a little bit here so we can see it. $28 trillion is an enormous amount of money. In fact, the debt per taxpayer in the United States is $224,000 estimated. But what's also important to recognize is that each state has got its own set of financial problems, and they are printing money as well, with an estimate of $1.2 trillion of state debt. But that's not all. You know, the United States has certain obligations, certain promises that it's made for things like Social Security, Medicare, and other things. And the estimate for that U.S. unfunded liability right now from the U.S. debt clock is $162 trillion. And that is a remarkable number, especially when you consider that the total U.S. national assets are expected to be or estimated to be $161 trillion. So these numbers are staggering and almost impossible to consider. But when it comes to planning, we really have got to think about these numbers and what it means to our clients and the future generations. So we need to talk about taxes and tax preferential tools for our clients. And heck, I mean, I would love the tax triple play if I could find it. Something that was deductible, something that was deferred, something that was tax-free of income and estate tax-free as well. Now, I haven't been able to find that, and I heard it's something called a unicorn, and I haven't been able to find one of those either. Forgive my levity, but you got to understand that getting the triple play just doesn't exist. You can't have all three of these, but maybe, just maybe, if you can give up the deduction and you can get deferred income later and tax-free transfer later or tax-free income later, that would be a good thing. And only you, though, can decide what's best for your clients and yourself. So let's talk about things, tax deductible items that might be available to your clients now. Well, heck, you've got retirement plans, from 401k plans to defined benefit plans, if you can find one, even deductible IRAs. Your clients can make sizable or small contributions to charity, which reduce their current income tax situation and can reduce their estate tax. We certainly have heard of billionaires, for that matter, that have promised massive gifts to certain nonprofits as part of their philanthropy. And I think that's a wonderful thing. But for the average person, that can only go so far. So the next thing we need to consider in our triple play would be tax deferred items. Again, let's come back to retirement plans. Even Roth IRAs, while not deductible, they offer tax deferred growth and tax-free income. You've got other things like unrealized capital gain in investments, real estate, and even businesses. But ultimately, those deferrals and other things will have to pay some sort of taxes when you ultimately want to receive that money. And life insurance, cash surrender value is also a tax deferred vehicle. Let's talk about tax-free income. Roth IRA withdrawals, municipal bonds provide some tax-free income depending on the yield. That could be good or not so good, but it is in your estate, and as well as in a Roth IRA. And we need to consider that when we're dealing with some wealth transfer items. Life insurance also enjoys certain exemptions where withdrawals from life insurance to basis, which is up to your premium contributions, would not be subject to tax. And loans issued by insurance companies against the policy cash value is not taxable at all as well. We also have this great tax-free potential with the life insurance death benefit proceeds. And depending on your situation, insurance companies offer special riders that can provide tax-free distributions from policies for living benefits like chronic care or critical illness. So life insurance is a little special in that regard. We can also talk about tax-free estate planning. Life insurance proceeds can help when it comes to planning, can provide the necessary monies outside of the estate to take care of any bills that might come. And with proper structure, it will be exempt and can pass through to next generations without any taxation. And clients can also take advantage of gifts. Gifts are available every single year. And then you have your lifetime gift that can be made up to a massive amount right now of, more than 11 million per person. And if you have a couple, that's more than 22 million. Under the current administration's proposal in Washington, though, there are dramatic reductions coming, potentially down to $3.5 million per person. So if you have the means, gifting right now to avoid estate tax would be ideal. So life insurance is a timely tax tool, as I've been saying. It's special. It enjoys certain tax benefits that other things just don't. While it's not deductible, although you can buy insurance in a qualified plan, distributions from the qualified plan will be subject to tax. But I have to ask a question. Would you be willing to give up a deduction today for no tax in the future? In fact, saying it another way, would you rather pay tax on $5, $10, or $20? I think the answer for most people is I'd rather pay tax on the smaller amount. Well, when it comes to life insurance, that's exactly what we're discussing. We'll pay tax on the premium. We won't pay tax potentially on the cash value buildup. And because life insurance enjoys certain tax-free benefits, life insurance death benefits are exempt from taxation. So let's use this and its tax preference items as a way to help your clients plan. So here's an idea. It's a safe money idea, life insurance potentially, where we have a client with $250,000 sitting in, whether it's another investment, taxable investment, where we would allocate that $250,000 to a life insurance policy. In this case, our guy's 60 years old, and that $250,000 lump sum into a life policy would buy $579,500 of death benefit. So with this particular carrier showing minimum account interest rate credit of 2.5%, your client might see $251,000 of cash value in year one. And if we're looking at an index product, as we are here, where we can credit more than 5%, your client's value could be $258 in year one. So this can be a CD alternative. It grows tax deferred, and if you cancel the policy, money would be subject to tax on the way out. And don't forget, there is a tax-free death benefit, God forbid something happens. And again, with certain carriers, we could tack on riders that can offer living benefits that can be accessed for things like critical and chronic illness payments. So this is a modified endowment contract, which means that, again, when we cancel the policy, the client would have to pay tax on the gain. But that's not so with all life insurance policies. So this timely tax tool can also provide tax-free income. In this case, we have an example of a 45-year-old male who's funding a qualified plan, has got some excess disposable income around, and would consider a complementary plan at $1,000 a month for 20 years until age 65. That would buy a life insurance policy with a $300,000 initial benefit and would provide 30 years of income at north of $39,000 for 30 years, with a total of $1.17 million of tax-free income over the lifetime. And another way of saying it, the client would have had to have about $1.9 million on a pre-tax level at 40%. This just happens to be an excerpt from the illustration showing $12,000 a year going in for 20 years, and then showing the tax-free income out of the policy at $39,000 plus for the next 30 years. Oh, by the way, still leaving the client with more than $200,000 of death benefit, God forbid something happens. So an awesome complement to other programs that your clients might be considering. But time is your best friend, so starting early is the best advice. But what about for estate planning? In this particular case, we have a wealthier client with some assets that they want to ensure don't get eaten up by federal and state estate tax levels, with goals here to maximize the gift to the next generation, be prudent, lower risk, minimize taxes. So we have an advisor here suggesting allocating money in trust for a $5 million policy, using the gift of $5 million as the source of the premiums. We're going to try not to diminish the trust principal. We're going to maintain flexibility for distributions, and it's going to complement the overall goal. So in this illustration, what we're showing is Plan A with $5 million invested at 5% with a 50 basis point management fee, netting 4.5%. And what we can show, net of 4.5%, is the $5 million initial investment growing significantly. Heck, in 15 years, if that were to occur, the heirs would get $9.6 million. Plan B, though, takes the same $5 million minus the asset fee, and we're going to purchase a $5 million policy from the income associated with the trust. So in this example, we're going to take $126,000 plus for a period of 10 years to fund a $5 million contract. So on day one, the beneficiaries would go from receiving $5.2 million under Plan A to more than $10 million under Plan B. And it appears that during the entire duration, somewhere around life expectancy in year 28 or age 87, the heirs would get $17 million without life insurance and more than $18.5 million using life insurance. So life insurance provides stability all the way through. Life insurance potentially can yield a larger net benefit to the beneficiaries. And again, it's tax-free. So we want to conclude our call here today by saying we know you have questions, and we think we have some answers and some ideas that you might be able to utilize. We look forward to speaking with you, and we absolutely look forward to you joining us 2 weeks from today at 1 p.m. for Life Insurance, a Timely Tax Tool Part 2, where we'll dive a little bit deeper into a few things that we think you'll find interesting. So with that, we'd like to thank you for viewing today. Contact us to discuss your next case, and we wish you a great tomorrow. Bye-bye now.